Right, people. So, welcome to lesson three of our fundamental analysis. And what we're going to be covering today is treasury notes, yield, convent of traders report, and open interest for long-term market outlook. So, in this section, we're dealing with fundamentals, and we're utilizing fundamentals to understand where the market is going to go on a longer term basis. And basically, I decided to revisit open interest, COT, and that is what this section is for. So with that being said, let's take this text out of the way and let's look at DXY real quick. So this is a smaller range DXY, and if you look at the outcome from this range, you can see how expansive market was off of this range, right? So that tells us something on the fundamental basis happened inside of that range to cause the market to basically trade higher. Now, this is not a section for technical analysis, and this is not a section for technical analysis, right? But if you wanted to have expected what the market would do, basically you can see a weekly order block of this level, so we can place a horizontal line of that level. Basically, we could get this to the midpoint of this weekly order block, which is our main threshold. Okay, so our main threshold of the weekly order block is that level, and that acted as our support. You can see how the market stayed inside of this range. So oftentimes you hear me say that when you're basically what the central banks do is they work the market inside a small little range. So they create ranges where they can, assume positions inside of that range, and then the expansion of that range is simply a result of the net positions of the central banks inside of that range. So this the market basically got to this level and made a very extended range. Now, what I want to point your attention to is let's switch to the daily time frame. So we switch to the daily time frame. You can see our price acting nicely at this level. Okay, so price was stuck inside of this range, uh, kept tapping inside this range. Now, the question you're gonna ask yourself is, once price gets to this point and price begins to act like she know inside of a small range, that is where the central banks deal with price to assume positions, right? So the next question is the market going to keep trading lower in line with the bearish tone, or would the market make a reversal of this level? So what you can simply do is look at the fundamentals. Because remember, fundamentals drive prices long term. So this is where we check our treasury notes, which is our primary uh, futures that we want to use to track fundamentals. As you know, what actually moves the market on a fundamental basis is interest rate yields. And I explained that in the first video of this fundamental series. Interest rates yield drives prices in the marketplace. So what we want to do is we want to look at what the 10-year treasury note is, which is the bond price. Okay, so the US bonds indicated by the 10-year treasury notes. We want to see what the 10-year treasury note is doing so we can understand where yields, if yield is higher or if yields are going lower, to know if on a fundamental basis we can expect higher prices, because remember, currencies chase yield. Okay, so currencies chase yield. Right. So uh, remember, if the 10-year treasury note is on a downtrend, right, you want to see the DXY, okay, go on an uptrend, right, because you're oppositely correlated. Treasury note is the bond price, and then the DXY is simply a reflection of yield. So if you check back again to our first video in this section, which is our fundamentals, right? So what I said was currencies always seeks yield, and if the yield of a country is high, that is going to that is going to cause a flock of investment into that country's economy, which is going to increase the prices of that country's currency. Right, but if bond prices are going lower, that means yield is going higher. If bond prices are going higher, that means yield is going lower. So if yield is going down, that means currencies go down. If yield is going up, currencies go up. All right, so now, and if you know, I also said something like, if you, whenever you see the uh, 10-year treasury note basically making the same movement as the DXY, which is a reflection of the yield. That is going to indicate that price would be stuck in a range. So some of you might ask, Gene, what do you mean by that statement? So what I simply mean is, if you look at DXY, right, from if you look at this low, so remember DXY is oppositely correlated with 10-year treasury note. So if you look at the 25th of January 2018 to the 16th of February 2018, you can see the DXY made a lower low. Now, if the DXY is oppositely correlated with the 10-year treasury note, you want to see the 10-year treasury note make an higher high, okay, because you're oppositely correlated. So if the DXY is making a lower low, you want to see the 10-year treasury note make an higher high to show that divergence, that LV divergence you want to see between the dollar and the dollar futures contract and the 10-year treasury note. Okay, but now between January 25th to February 16th, DXY was making lower low, and if you check the treasury notes, okay, the 10-year treasury notes, right? So that was making a lower high. So remember, you're not meant to move in the same direction. You're not meant to move in tandem. You're moving in tandem. That means that yield is not really doing anything. Yield is not seeking higher prices, or nor is the yield seeking lower prices. And that means there's an indecision currently in that marketplace, or there's orders being worked in the market. So that is going to cause a range to form in currency prices, as you can see on the dollar. This is a reflection of the dollar. Look how the dollar kept making a range. Reason why being that at that point where the dollar was making a range, US dollar futures contract was making lower lows, and the same time, or at the same time, the 10-year treasury was also making lower highs. Okay, which is not meant to be. All right. So now, if you watch from 16th of February all the way up to 26th of March, the DXY, which is the reflection of yield, was making higher lows. Now, normally what you want to see on the 10-year treasury note is when the DXY is making higher lows, you want to see the 10-year treasury note make lower highs. Okay, but now if 10-year treasury note is also making higher highs, that means that the DXY will keep being in the range. So that's what the 10-year treasury note actually did. So in the same time period uh, from 16th all the way up to 26th, 10-year treasury note was also making higher highs, okay, which is not meant to be. So that means that range on the DXY still continues. And if you check the DXY on the currency chart, you can see in the same time period, right, from 16th all the way up to 26th, there was still a range. So price was trading inside of a range. Okay, so now the defining moment where you can expect for price to break out and you can know the direction of price, where price would go to in this very large consolidation is, look at what the 10 treasury is doing. Okay, so now from let's check the dollar futures contract first. So from the 26th of March all the way up to the 4th of April, DSY was making higher highs. Okay, and for a LV divergence, want to see the 10-year treasury note make lower highs. Okay, and you can see LV divergence now correlation. You're oppositely correlate now, right? So you're seeing the 10-year treasury note in the same time period make lower highs. Now the market has tipped its ends. The central banks have tipped their ends where they're trying to move price to on the fundamental basis. So treasury note is going to want to seek lower prices. If treasury note is going to seek lower prices, we definitely know that yield is going to go up. And if yield is going up, that means currencies go up. And you can see at this time frame where the LV divergence between 10-year treasury note and the DXY futures contracts came in the marketplace. Look how the market exploded. So this is the same time frame as reflected on the currency, and this was the last low inside of this range before the market exploded. So you see how we just by simply looking at the fundamental aspect, we were able to know the positions that the central banks were working inside of this range, and they basically tipped their hands and we know where you're going on the longer term basis. Okay, so also one more thing I want to point out to you guys is, if you notice, while price was inside this range. Okay, let's now bring up our COT data. So let's pull this down a bit lower. So you notice, whilst price was inside this range, the COT was above the midpoint of its range, above the zero mark. Okay. Remember, if the COT is above the zero mark, that means we're net long on a central bank basis. Okay, so longs are being accumulated inside the range, inside of this range, and you can see as price started to trade higher, the net long positions were being distributed to the downside as price crossed the zero mark. So this is what you can use as an alignment with your analysis on the fundamental basis. Just COT to support what you're looking for. Although opening trade did not really indicate what price wanted to do, but COT is supporting longs in the marketplace via price getting to above the zero mark, which is an indication for long accumulation. And as price starts to trade away from the top back down, okay, we know that you're now distributing your positions accumulated inside of this range. Okay, so now we have divergence to verify that this is where we're going to go long on a fundamental basis, and also COT data has shown us that price is willing to go to the upside, and you can see the institutional sponsorship indicated by this very extended move all the way from April up until August. Very extended move to support that central banks were really net long and worked massive positions inside of that range just by simply utilizing the all the divergence between the dollar index and the 10 years treasury note. Okay, so with that being said, that brings us to the end of this section. I'll see you guys next time.